The AI trade may be chasing the wrong bottleneck.
Chips get the spotlight, but optics, power, cooling, networking, and cloud capacity may decide what scales next.
Think of an AI data center as a factory. The model is the product. The GPUs are the machines.
And the machines still need roads, wires, air conditioning, and a very large electric bill.
Tiny joke, serious point. When one layer gets tight, that layer can become the market's next obsession. First, AMD. In Q1 2026, AMD reported revenue of $10.3 billion.
The important part for this story is the data center segment. It reached $5.8 billion, up 57% year over year.
Now compare that with Nvidia. Nvidia's latest reported data center quarter was $62.3 billion, up 75% year over year.
So AMD is not close to Nvidia's scale. But it shows something important. The demand wave is broad enough that the challenger is also growing.
So this is not just a stock reaction story. It is a capacity story.
Here is the stack we are tracking: compute, architecture, networking, optics, power, cooling, servers, and AI cloud.
In the compute layer, Nvidia is still the giant. AMD is the challenger. ARM sits underneath a lot of modern compute as an IP and architecture layer.
Then the data has to move. That brings us to Arista for networking and Corning for optical fiber and connectivity.
Then everything has to turn on and stay cool. That brings in Vertiv and Eaton.
Finally, someone has to assemble, finance, and rent the capacity. That brings in Super Micro and CoreWeave, where growth can be explosive and risk can show up fast.
The second signal is the Nvidia and Corning partnership.
Corning is not a new AI stock in the way most people think about AI. It is a materials and optical communications company.
But AI data centers do not just need chips. They need fast, reliable connections between racks, clusters, and facilities. Boring until it becomes scarce.
Corning's Q1 2026 optical communications sales grew 36% year over year.
And Nvidia partnering around optical connectivity tells investors where the physical constraints may be moving.
Arista is another useful example. Q1 2026 revenue was $2.709 billion, up 35.1% year over year.
The interesting part is quality. The latest data shows operating margin above 40% and trailing 12-month free cash flow above $5 billion.
That does not make the stock cheap or expensive by itself.
But it does show why serious research separates revenue growth from business quality.
The educational question is, who helps the data center do more work in less space with less power and fewer constraints?
This is the screen that keeps the story honest.
Several companies can benefit from AI infrastructure, but the reported economics can look completely different.
On this screen, compare revenue growth, operating margin, and trailing 12-month free cash flow.
That is why charged alpha separates the theme from the financial profile. A hot theme can still have cold cash conversion.
This is where the Corning story gets more interesting than a normal supplier announcement.
The release said the partnership is intended to increase United States optical connectivity capacity by 10 times.
It also targets more than 50% of Corning's fiber production in the United States, plus 3 new manufacturing facilities.
And there was a financial signal too. Corning disclosed a warrant package with Nvidia tied to a $500 million aggregate purchase price.
For this video, the point is not to say what Corning is worth. The point is that Nvidia appears to be securing a critical piece of the AI factory stack. Now we get to the layer that may be easiest to understand: power.
If a data center cannot get enough electricity, the GPUs do not matter. If it cannot remove enough heat, the servers cannot run at full density.
Vertiv reported first quarter net sales around $2.65 billion, up about 30% year over year.
Eaton reported record first quarter results and highlighted Electrical America's order acceleration up 42%, driven by data center momentum.
This is where the AI trade leaves the slide deck and hits the wall socket. Transformers, switchgear, cooling units, backup power, grid connections, and construction timelines.
The International Energy Agency has highlighted AI and data centers as major drivers of electricity demand growth.
Morgan Stanley has also warned that power access could become a constraint later this decade.
So the simple version is this: when the power meter moves, portfolios tend to notice.
Here's the loop in plain English.
Cloud customers commit capital. That demand pulls forward compute orders, networking, optics, power equipment, cooling, and construction.
Then the test changes. Can all of that planned capacity become usable capacity on time?
That is why bottleneck layers can matter so much. The constraint can move, and the market often follows the constraint.
This is the part of the AI trade that does not fit neatly into a software narrative.
Electricity supply, grid connections, thermal density, and equipment lead times can all slow the conversion from planned CapEx into usable data center capacity.
That is why order growth, backlog, and delivery timing matter for companies like Vertiv and Eaton.
They are not just industrial side stories. They help determine when the AI factory can actually turn on.
Now for the dangerous part of the stack.
Super Micro and CoreWeave are examples of companies tied directly to AI build-out. But this layer can be capital-intensive.
Super Micro's latest quarter showed net sales above $10 billion, more than double the year-ago period.
But the latest data also shows lower operating margin than the software-like AI stories, and negative trailing 12-month free cash flow.
CoreWeave reached more than $5 billion in annual revenue for 2025, with reported revenue backlog of $66.8 billion.
That is massive growth, but it is still a different kind of risk.
Some businesses collect tolls on the AI build-out.
Others have to finance the road before the tolls arrive.
Revenue growth gets attention. Cash conversion decides how durable the story can be.
So how should an investor study this without chasing every AI headline?
Use a four-part framework. First, layer. Which part of the AI factory does the company serve?
Second, growth. Is the company actually seeing AI demand in reported numbers?
Third, quality. Does the growth come with margin, cash flow, and pricing power?
Fourth, risk. Is the business exposed to valuation, customer concentration, debt, export controls, or a CapEx pause?
That framework keeps this from becoming a ticker parade. It forces each company into the job it actually does.
Going forward, the best tell will not be one headline number.
Watch data center segment growth, optical orders, electrical backlog, operating margin, free cash flow, and customer concentration.
If growth stays high but cash flow gets worse, that tells one story.
If growth stays high and margins expand, that tells a very different story.
That is why this theme needs a framework, not a hype cycle. The biggest mistake would be treating all AI infrastructure stocks as the same trade.
Exactly. A GPU company, a fiber supplier, a power equipment company, a server builder, and an AI cloud platform can all ride the same build-out.
But they do not have the same economics.
The market is not just asking who is exposed to AI.
It is asking who controls a bottleneck and who turns that bottleneck into cash.
Charged Alpha uses frontier AI workflows to turn fresh earnings data into clear stock research, from deep dives to educational breakdowns like this.
Subscribe for more AI-powered financial media, earnings stories, stock comparisons, and investing education.
And remember, this is educational content only, not financial advice.